3 years in nursery, 8 years in primary school, 6 years in secondary school, 3 years at university studying finance and accounting. And never once did I hear the word credit in the sense that it would practically help me in my daily life. I find it absolutely shocking that we're not taught this in school, knowing that the backbone of our financial system is built on it, and that it will massively impact our life. If you feel that way too, don't worry, you're not alone. Understanding credit makes an entire difference between winning and losing at personal finance. Learning about credit has helped me save several thousands of pounds over the years. Most people focus on cutting back on coffee when starting their journey to financial independence, which is not necessarily a bad thing. But learning about credit and applying it will have a greater impact on your finances than saving a few pennies on coffee. In this video, I demystify the word credit so that you don't have to, and show you that word so that you can practically apply it on a daily basis. Without further ado, let's get started. Establishing good credit is the first step in building a great financial infrastructure. Simply defined, credit is the way by which financial institutions decide if they're going to lend you money or not. And to help them make that assessment, there are two main components they look at: your credit report and your credit score. Your credit report gives them basic information about you, your account, and your payment history. It tracks all your credit activities, such as your loans and your credit card, keeping in mind that your most recent activities are given the higher weight. Your credit score is a number between 0 and 999 if you use Experian. Experian classifies a grade score between 881 and 999, so the higher your score is, the better. This number represents your risk profile to lenders, which basically means how likely will you be able to repay the debt plus the interest should they decide to go ahead and grant you the loan. So your credit score and your credit report helps lender decide if you would be eligible for a loan, and more importantly, what interest will you have to repay on that loan. Now, let's be clear about the term interest rate. The interest simply represents the cost of the money that you're borrowing, and is generally a percentage of the amount that they lend. It is important to notice that there's an inverse relationship between your credit score and the interest rate that will be payable on the loan. So if your credit score is high, the lower is the interest rate you have to pay on the loan. Conversely, if your credit score is low, the higher is the amount of interest rate that you have to pay on the loan. As a matter of fact, I suggest you open an account with Experian today to get your credit score and download your credit report. I use Experian because it is the most used by lenders in the UK. That means that whether you're submitting an application for a car loan, an education, or personal loan or credit card, they will check your details with Experian. You can sign up with the link on the description. It's free. Once your account is created, sign up to their basic 30 days free trial subscription to download your credit report. And as soon as you've downloaded your credit report, you can cancel the subscription right away so you won't get charged after 30 days. This won't cost you a dime. When I say that learning about credit and purposely trying to improve my credit score has helped me save thousands of pounds over the years, people always assume that the amount that I save is in the range of 2 grand, 3 grand, 5 grand. I'm talking about saving £200,000 over a 30-year mortgage on a 1-bedroom flat apartment based in London, costing £300,000. The difference between having to pay 7% in interest having a bad credit, or 4% in interest having a great credit. Shocking, right? If you want to go into more detail with this, click on how much are you saving by having a good credit score in the description below. You can use this mortgage repayment cost calculator to play around different interest rates to see how much you could be saving depending on the interest rate you use. Now that we know what institutions look at when deciding whether to grant us credit or not, let's now have a close look at metrics that will allow us to improve those two elements to make sure that we always get money at a cheaper rate. There are 3 important metrics that you need to pay close attention when it comes to analyzing your credit report. Number 1, your credit utilization rate. Number 2, your debt repayment history. Number 3, the age of your credits. I want to talk about each of those elements, but more importantly, the consequences when they are not followed. Your credit utilization rate represents 30% of your credit score. This forms the second largest chunk of your credit score, so you should be looked at carefully. Your credit utilization rate sounds like a fancy term, but it simply means how much of your credit limit had you used. According to the Experian, you want that number to be less than 25%. And how do you find out about it? All you do is that you divide your balances on your credit card at the moment by your credit limit. If you get 25% or less, then you're good. If it's over 25%, then you're in trouble and you need to look at ways to reduce it down to 25%. I shot an entire video on this topic showing you various ways of ensuring that you're always below 25%. The second matrix here is your debt repayment history. This forms 35% of your credit score. This is the largest chunk of your credit score. So if there's only one element you could focus on to make sure that you improve your credit score, this should be the one thing. How do you improve your debt repayment history? Is by making sure that you pay your debt at the end of every month in full and on time. And to make sure that this is done automatically, you set up a direct debit so that you don't have to think about it. It's automated and it's good to go. Every month it happens without you checking that it's happening. You set it up once and you forget about it. I shot an entire video here where I talk about this in more details. Now, I want to talk about various consequences that will arise if you don't follow this rule. Now, consequence number one, if you miss a debt repayment, your credit score will drop by more than 100 points straight away. That happens automatically. This could easily add an extra £250 repayment to a 30-year fixed interest mortgage. The second consequence for missing a payment on your credit card is that your interest rate could go up to 30%. Assuming that 18% is the lowest interest rate that a bank can offer on a credit card in the UK at the moment, that's an increase of 67%. Let's translate this into numbers. We're talking about a difference of £2,400 between paying 18% interest and 30% interest on the loan of £20,000. The third metric we look at here when it comes to improving your credit report and your credit score is the age of credit. So that means that the longer you have a credit, the better it is. Note that age of credit represents 15% of your credit score. So keep your credit card, your existing credit cards for a long time and keep them active to ensure that you improve this metric. The longer you have had a mortgage, the more reliable you look to lenders. The longer you have had the credit card active, making your monthly repayment in full and on time, the more reliable you look to lenders. If you have a major loan application going through at the moment, do not close any existing credit card that you have, as you need all the credit sources that you can in order to get a better rate. Note that credit card is not the only source of credit that you can get out here. You have service credit, you have installment loan, you have mortgage, you have personal line of credit, you have home equity line of credit. All of these sources need to be maintained, and the way they are maintained is by you making a repayment on all of these credits every month and in full to ensure that they provide you the sources that you need to have a better rate whenever you decide to apply for a loan. So the age of credit is that important because it gives the lender enough information about your credit habit to give them the comfort that you will be able to repay your debt. However, if you don't have any major loan application going through at the moment and you have existing card that you haven't used in a while, so you've paid all the expenses on those credit cards and they're no longer used, you might as well close them because that also shows a bit of responsibility from your part. You've used that credit and you no longer use it and then you close the account. It also shows that you're a responsible borrower. Closing accounts that are no longer used will also allow for simplicity in managing your finances. And remember, building a great credit score is just the first step of building a great financial infrastructure. Thank you guys for watching. If you got tremendous value out of this video, please click that like button. I'll be dropping a new video every week, so subscribe to the channel to ensure that you don't miss anything. If you have any question about what we discussed today, please leave a question down below in the comment section. I'll shoot a video to answer them. Now, click on this video right here to find out ways to perfecting your credit utilization rate as we discussed earlier. I really appreciate the fact that you spend your most precious asset to watch this video, which is your time. It would be a shame for that time to go to waste. So please take some time during your day, during your week, over the weekend to implement some of the suggestions I'm discussing on this channel. Your financial situation will not improve by only listening to me, but by applying some of these suggestions. Now, go take action.